Let me be absolutely clear with you from the first second of this video. Gold, silver, and oil are not behaving the way your favorite social media guru told you they would behave. And if you are sitting right now with a smug smile on your face because you loaded up on commodities thinking this bull market was going to run forever, I need you to wipe that smile off immediately. Because what the charts are telling us right now is not a suggestion, it is not a maybe, and it is certainly not a wait and see. It is a cold, hard, mathematical warning that most retail investors are going to completely ignore until it is far too late and their portfolio is bleeding out on the floor. I've spent decades studying markets, and the confluence of signals I am seeing across gold, silver, and oil right now is one of the clearest, most precisely mapped technical setups I have encountered in years. I have exact price targets, I have timelines, I have levels, and I am going to give all of it to you today because, frankly, you need it more than you know. Now, before we go any further, I want you to do something right now. I want you to hit that subscribe button immediately, and I am not asking nicely. I am telling you the kind of analysis I'm about to walk you through, with specific price levels, channel discoveries, downside targets, and timelines would cost you thousands of dollars a month at any serious institutional research desk. You are getting it for free right now, simply by subscribing to this channel. That is the deal. You subscribe, you get the truth. You don't subscribe, you go back to Twitter and CNBC, and you can enjoy losing money with everyone else. Your choice. Subscribe now. Let us start with oil, because oil is where the story begins, and it is also where the most painfully obvious I told you so moment is currently unfolding in real time. Cast your mind back, not very long ago. Go on social media, pull up any financial forum, any commodity trading group, and what were people saying about oil? They were screaming that it was going higher. They were talking about geopolitical escalation, supply disruptions, the end of cheap energy, the collapse of global supply chains, and every single narrative you can imagine was being weaponized to justify one conclusion: buy oil, hold oil, oil is going to the moon. And here's what the chart was saying during all of that noise. The chart was saying absolutely none of that matters because we have a bear flag, we have a topping tail, and this thing is coming down. Let me explain exactly what happened and exactly where we are going, because you need to understand not just the conclusion, but the mechanical logic that produced it. When you look at the oil chart, you can identify a classic bull move that preceded a period of consolidation. That consolidation formed a pattern that technical analysts call a bear flag, which is essentially the market taking a breath before it continues in the direction of the primary trend, which in this case is down. Before that consolidation, you had a final bullish blow-off top, which is the market's last gasp of optimism before reality reasserts itself. Now, here is something fundamental that you must understand if you want to stop losing money and start winning. When price breaks through resistance on the way up, that resistance becomes support. That is not magic. That is not luck. That is just the mechanical behavior of markets, the memory of price, the weight of accumulated transactions at specific levels. And so when oil pulled back and found support at those prior resistance zones, that made perfect technical sense. The question then became whether that support was going to hold. And based on the parallel structure of the channel, based on the bear flag pattern that had formed, based on the topping tail signal that preceded the move, the answer was no, it was not going to hold. And the breakdown was coming. That breakdown has now happened. The bear flag has broken. The topping signal has played out exactly as the chart projected. Oil is heading lower, and you need to have two numbers burned into your brain right now. The first downside target on oil is approximately $77. That is your near-term destination. But do not make the mistake of thinking that is where the story ends, because further down the road, particularly as the U.S. economy continues to show signs of stress and weakness, the real downside target on oil is $67 and change. There is a gap on the chart at that level, and gaps get filled. Markets are relentless about filling gaps. It may not happen tomorrow, it may not happen next month, but that gap is sitting there like an unpaid debt. And eventually the market is going to collect. I want you to think about that. The next time someone on social media tells you to load up on oil because of some geopolitical headline, now let us talk about gold, because this is where things get genuinely extraordinary. And I do not use that word lightly. I have been in this business long enough to know that genuinely elegant technical setups are rare. And when you find one, when the chart lays itself out with mathematical precision and internal consistency that takes your breath away, you pay attention with everything you have. What has emerged on the gold chart is one of the most beautiful parallel channels discoveries I have seen in a very long time, and I want to walk you through it step by step, because understanding this setup is going to be the difference between you making money and you being the bag holder that the smart money is selling into. Here's the reality of where gold currently sits. You have a resistance zone up at around $5,400, and you have a support zone down at $4,300 to $4,400. Those are your outer boundaries. But the truly important story is being told by the internal structure of the price action. And that internal structure is painting a picture that is simultaneously exciting and deeply cautionary. When you examine the angle of the current price incline on gold, something remarkable emerges. The angle of this move, the slope of the line connecting the recent lows, is virtually identical to the angle of a prior incline that appeared earlier in the chart structure. And what happened after that prior incline? There was a sharp dump. The market fell hard. And now here we are again, watching price replicate almost exactly the same angular move with the same inside bar structure, the same consolidation patterns, the same sequence of events playing out like a film you have already seen. This is not coincidence. This is the market expressing its internal logic, its behavioral memory, its tendency to repeat patterns, because human psychology does not change. Fear and greed are constants. The chart is simply the visual record of those constants expressing themselves over time. But here's the critical second piece of this parallel channel discovery. And this is the part that gives us our upside. Target with genuine precision. When you take a trend line connecting the highest point of the recent bounce and drag a parallel line down to align with the significant lows on the chart, those lows match up with extraordinary accuracy. The parallel is clean, the alignment is precise, and what that parallel channel tells us is this. Gold has room to continue moving higher before the next significant leg down arrives. Based on this channel structure, based on the confluence of technical levels and the parallel geometry of the price action, gold has a realistic upside target of $5,000 to $5,100. That is where the parallel channel resistance intersects with prior levels of technical significance. That is where the smart money is likely to be waiting. So you have your upside target, $5,000 to $5,100 on gold. Now comes the part that most gold bulls are going to absolutely refuse to hear, because they are emotionally invested in a narrative, and nothing I say is going to reach them until the market itself delivers the lesson through their actual account balance. Once gold reaches that $5,000 to $5,100 zone, the structure of this chart tells us that the next major leg down begins. And when I say major, I mean major. This is not a dip buying opportunity. This is not a hold through the pullback situation. This is a structural downtrend asserting itself, and the pattern is classic: lower highs followed by lower lows, each bounce failing to reclaim the prior peak, each decline cutting to a new low. That is the definition of a downtrend, and that is precisely the structure that this gold chart is outlining. So where does gold go after it tops out in the $5,000 to $5,100 range? The first major downside target, the level where I would expect to see significant price support and potentially a meaningful bounce, is $3,900. That level is not arbitrary. It corresponds directly with a prior significant low on the chart, which means it carries real technical weight. The market has memory at that level. Buyers showed up there before. They will likely show up there again. So you will probably see a bounce off 3,900. And that bounce will feel like relief, and a lot of people will convince themselves that the bottom is in, that the bull market has resumed, that it is safe to buy again. Do not be one of those people, because the final downside target, the level I'm looking at as the ultimate destination before the next genuine bull cycle begins in gold, is $3,500. $3,500. Write that number down. Tape it to your monitor, because understanding that this target exists, understanding that the chart is pointing there, is the only thing that is going to prevent you from averaging down into a falling knife and destroying your capital in the process. The parallel channel, the internal structure of the price action, the confluence of support and resistance levels, all of it coordinates around that $3,500 level as the place where the real bull cycle in gold will eventually launch from. Between here and there is significant pain waiting for the unprepared. Now let us move to silver, because silver has its own story to tell, and it is both similar to gold in structure and unique in its specific levels and timeline. Silver right now is sitting in a setup that is a textbook example of a bear flag pattern. And if you understand what a bear flag means and what it implies for price, then you already know that the near-term picture for silver is not bullish. Regardless of what any silver bug on the internet is telling you, here is the structure. You have a significant down move that preceded the current consolidation, and that consolidation is forming with support in the $64 to $66 zone, which has served as a classic for with the price putting in small bottoming tails through that area. The consolidation itself is either flat to slightly inclining, which is exactly the character of a bear flag, and the internal count of the price bars within the flag is consistent with what you expect to see before the next leg lower arrives. But here is where you need to pay close attention, because before silver rolls over and heads to its ultimate downside target, it is likely going to give you one more move to the upside. That is going to fool a lot of people. The short-term resistance level that silver needs to clear is $82, and based on the parallel channel structure that mirrors what we saw in gold, silver actually has the potential to push through that $82 resistance level before the real selling begins. And when you connect the significant lows and drag a parallel channel up, the upper boundary of that channel gives silver room to push higher before the larger trend reasserts itself. That move toward and potentially through $82 is going to feel like a breakout to the people who are not reading the chart correctly. It is going to generate excitement, and the silver community is going to erupt with "I told you so" posts and price target threads, and that excitement is going to be the fuel that the smart money uses to distribute their positions into the hands of retail investors. Do not be the person on the wrong end of that distribution. Now let us talk about exactly where silver is ultimately headed, because this is the part of the analysis that has the most specific and actionable timeline attached to it. And I want you to understand not just the price target, but also the time dimension, because knowing when something is likely to happen is just as important as knowing what is likely to happen. The parallel channel structure on silver, when extended forward on the chart, tells us something very specific about timing. We are currently in mid-April. June is not far away, and when you extend the lower boundary of the parallel channel out to approximately June and into July, something significant happens. The channel boundary converges with a critical support zone that represents the maximum downside target for silver. My final downside target on silver, the level where I believe the larger corrective move will exhaust itself before the next genuine bull cycle begins, is approximately $50. $50 on silver. That is not a typo. That is not me being dramatic for the sake of the video. That is what the parallel channel structure, the technical levels, and the internal logic of the price action are pointing toward. And the timeline attached to that target is July now. Let me be very clear about something, because I know how people hear these kinds of projections. This is not a guarantee. I've never claimed to be infallible, and any analyst who tells you they are 100% accurate is lying to your face. Charts can fail. Patterns can be invalidated by unexpected news, by geopolitical shocks, by central bank interventions, by the 1,001 variables that make markets genuinely complex systems. But here's what I will tell you. I am not operating on emotion. I am not operating on a narrative. I am not operating on a hope or a wish or a conviction that silver is money and therefore must go up forever. I am operating on the cold, mathematical logic of price action and channel geometry. And that logic is telling me that silver at $50 in July is the high probability scenario, and what you do with that information is entirely your decision. But you now have it, and you no longer have the excuse of ignorance. All right, you have made it to the end of this video, which tells me one thing. You are not like the average retail investor who bails after 30 seconds because the truth is uncomfortable. You stayed, you listened, you absorbed the analysis, and now I am going to give you your final orders, because that is what this is. These are orders, not suggestions. You now have the exact upside target for gold at $5,000 to $5,100. And you know that after that target is hit, the downside targets of $3,900 and ultimately $3,500 are waiting. You know that oil has broken down with targets at $77 and eventually $67. You know that silver is likely heading to $50 by July with a potential fake-out rally to $82 first. You have the map. The only question left is whether you are going to use it or whether you are going to ignore it and then complain on the internet when the market does exactly what this chart said it was going to do. I have zero tolerance for that kind of financial self-sabotage, and frankly, neither should you. So here's what you are going to do right now. You are going to subscribe to this channel. You are going to share this video with every investor you know who needs to hear this. And you are going to show up for the next video because the markets are moving fast and the next set of signals is already